Meta just became one of the most interesting debates in the market. A cash machine on one side, massive AI spending on the other. In this video, we will break down the business, the risks, and the key numbers investors should actually watch.
Welcome to this explainer for Markets DeepDive. Today, we're taking an objective, entirely data-driven look at Meta platforms. No hype, no stock-picking tips, just a clear, practical breakdown of the business, its core drivers, and the real risks as we analyze the company in May 2026. Let's get right into it. So here's the core question we really have to answer today. Is Meta still just a social media company, or has it actually become one of the most important AI-driven advertising platforms in the entire world? You know, understanding this identity shift is absolutely key to grasping how the market is pricing this stock right now. Before we dive in, please note, this explainer is for educational and informational purposes only. It is not financial advice, investment advice, or a recommendation to buy or sell Meta stock or any other security. Always do your own research and consider speaking with a qualified financial professional. Markets DeepDive is here to teach you how to think clearly, not what to buy. Here is our framework for today. We'll start with the Meta ecosystem, then look at the profit engine. After that, we'll weigh the growth drivers against the risks, explore the valuation mindset, and wrap up with your ongoing investor checklist.
All right, part one, the Meta ecosystem. Let's look at what Meta actually owns.
Meta's business operates with this really fascinating dual nature. On one hand, you've got the family of apps, Facebook, Instagram, WhatsApp, and Messenger. This is the revenue engine, and it's entirely powered by digital advertising. But then, on the other hand, you have AI and reality labs. Now, this is the highly capital-intensive future where they are spending billions on Meta AI, llama models, data center infrastructure, and of course, those metaverse initiatives. Honestly, the tension between this massively profitable app ecosystem and the cash-burning tech labs is exactly what defines Meta today. Moving on to part two, the profit engine. Let's talk about scale and margins.
3.56 billion. That is Meta's daily active people, or DAP, as of the first quarter of 2026. Just think about that. It represents global user attention on a massive scale. And in the advertising model, when you combine user attention with deep ad targeting, you get advertiser demand. When you literally have nearly half the global population engaging with your platforms every single day, you command immense pricing power. This is the engine that prints the cash.
Now, the underlying financials reveal a pretty striking contrast. In Q1 2026, revenue hit $56.3 billion. That's a massive 33% year-over-year growth, and operating margins stayed incredibly stable at 41%. But take a look at the capital expenditures. CapEx jumped from $6.7 billion to nearly $19.84 billion in just 1 year. I mean, that's a staggering 196% increase. So yes, they're printing cash, but they're also pouring historic amounts right back into the business for AI infrastructure. Section 3. Growth drivers versus risks. Let's take a balanced view.
On the growth side, the foundation is remarkably solid. We're seeing AI-powered tools driving much higher efficiency for advertisers, which naturally justifies premium ad pricing. This is actively pushing up their global average revenue per user. Plus, they're unlocking new cash flows by successfully monetizing Reels and business messaging on WhatsApp. Add in a phenomenal 82% gross margin for fiscal year 2025 and a highly conservative debt-to-equity ratio of just 0.26, and well, you're looking at a balance sheet built to weather economic storms.
But as objective investors, we have to weigh the risks equally. The market's primary anxiety right now, that massive CapEx spend. Investors are definitely worried about heavy AI infrastructure costs without an immediate return on investment, and that's compounded by continued heavy operating losses over at reality labs. Externally, Meta is fighting a multi-front war. There are intense regulatory and privacy pressures in the US and the EU, fierce competition for attention from TikTok and YouTube Shorts, and of course, the inherent vulnerability of relying on global macroeconomic advertising cycles. Which brings us to Section 4, the valuation mindset, pricing the future.
So, the crucial point we have to internalize is captured perfectly right here.
The key question is not only whether Meta is a great company, but whether the current price already reflects most of the good news. When we look at valuation conceptually, intelligent investors don't just see a good product, they compare growth expectations, margins, free cash flow, capital expenditure, and earnings quality against current market expectations.
And right now, market expectations are being heavily anchored by one massive range, $125 billion to $145 billion. That is their elevated CapEx guidance for 2026 alone. What's more, Mark Zuckerberg has confirmed plans to spend a staggering $600 billion on data center infrastructure by 2028. This historic level of spending compresses near-term free cash flow, which is exactly what triggered the recent price correction. The market is aggressively asking, okay, when does all this AI spend actually become profit?
Let's see how this all builds into the actual valuation as of May 2026. Because of that recent roughly 24% price correction driven by those CapEx fears, the stock is currently trading around $602 to $609. That's down from an all-time high of nearly $796. This drop has compressed the forward PE ratio for 2026 estimates to around 19 to 20 times earnings, which is actually below its historical average. Interestingly enough, despite the market sell-off, the broader analyst consensus remains a strong buy, with average price target sitting significantly higher between $826 and $870. So the debate right now is essentially between near-term CapEx pain and long-term AI dominance.
Section 5, your investor checklist. Let's look at the ongoing process.
Here's a highly practical framework to help you monitor Meta moving forward. Keep asking yourself these questions. Is revenue still growing? Are operating margins improving, or are they weakening under the weight of all that spending? Is this massive AI spending actually translating into better ad monetization? Are the Reality Labs losses being kept under control? Is user engagement, that massive 3.56 billion daily active user number, remaining stable? Is the valuation reasonable compared with future growth projections? And constantly ask, what risks could emerge that would fundamentally change this entire thesis?
Building a framework like this is absolutely essential. If you were just getting started as an investor, Markets DeepDive has prepared a free guide called the Beginner Investor Blueprint. It is designed to help beginners understand the basics before taking risk with real money. Goals, emergency reserves, core investing concepts, portfolio building blocks, execution rules, and a simple 30-day roadmap. You can download it for free at marketsdeepdive.com.
And if you want deeper, structured breakdowns of major companies, ETFs, and market trends, just like the objective analysis we did today, make sure to subscribe to Markets Deep Dive.
Also, if you are still learning, consider using a demo account before committing real money. Platforms like eToro allow investors to explore the market with virtual funds, which can really help you understand how positions, volatility, and portfolio decisions work before using real capital. Think of it as a safe sandbox to practice the analytical skills we've discussed today.
As we close, I want to reiterate, this explainer is for educational and informational purposes only. It is not financial advice, investment advice, or recommendation to buy or sell Meta stock or any other security. Always do your own research and consider speaking with a qualified financial professional. As you monitor this company moving forward, ask yourself, are we witnessing a mature social network reaching its peak, or are we looking at the foundational infrastructure of the next AI revolution? Keep diving deep.